This week, the most anticipated diplomatic meeting of 2026 was postponed. Donald Trump was supposed to be in Beijing right now, March 31st to April 2nd, the first American president to visit China since 2017, a meeting that markets had been pricing in for months. Then the Iran war intervened. The White House announced that Trump and Xi will now meet in Beijing on May 14th and 15th, a 6-week delay. Not a cancellation, but not nothing either. Beijing has remained vague on the delay, possibly giving itself more room to maneuver, but its tone remains positive. Here is why the delay matters more than the original meeting would have, and here is what it means for your money. Before the delay, negotiators from both sides had already been meeting. U.S. Treasury Secretary Scott Bessent met Chinese counterparts in Paris in mid-March. Chinese officials expressed openness to additional agricultural purchases. Both sides explored formal mechanisms to manage trade in non-sensitive sectors, including a proposed U.S.-China Board of Trade and Board of Investment. Progress was noted on critical minerals, with the U.S. pressing for access to yttrium, a rare earth element vital for jet engine turbines. One possible agreement under discussion involves China purchasing around 500 narrow-body aircraft from Boeing, a deal that could become one of the most significant commercial outcomes of the summit. That sounds significant, and some of it is, but here is what was quietly happening at the same time. Initial hopes that the visit could revive broader economic cooperation have steadily diminished. American business leaders had pushed for a large delegation of corporate executives to accompany the president, hoping to reopen channels for investment and market access. Such a delegation has not materialized. Deliverables have likely narrowed to commercial purchases such as soybeans, rather than any grand bargain, with the two leaders expected to frame the meeting as the opening of a longer conversation set to unfold across the rest of 2026. In other words, before the delay, expectations had already been scaled back significantly. The delay didn't kill a major deal, it postponed a carefully managed public relations event. This is where it gets interesting. The delay gives China a stronger hand. Here is why. 3 things happened between the original summit date and the new one. First, the Supreme Court. The U.S. Supreme Court struck down Trump's reciprocal tariffs, curtailing his ability to deploy tariffs at will and giving China a boost in leverage ahead of the summit. Trump's most powerful trade weapon was declared unconstitutional weeks before the meeting. Second, the Iran war. The U.S. is prosecuting a military conflict that is consuming political capital, diplomatic bandwidth, and economic attention. A lot of countries around the world are now rating China as a more reliable partner than the U.S. Beijing is quietly positioning itself as the stable alternative, and every week of the Iran war reinforces that positioning. Third, the Section 301 investigations. The Trump administration launched sweeping trade investigations that put China squarely in its crosshairs. Maximizing leverage before major bilateral meetings seems to be a standard move now. But China read this move accurately. It is a pressure tactic from a position that has been weakened by the court ruling, not strengthened. Only 3% of former officials and China experts surveyed by CSIS said both sides were likely to keep all their commitments in 2026. Just over half expected both to make partial efforts but fall short. The delay doesn't change the structural issues. It changes who has more time to prepare. The detail that matters most coming out of the Paris talks isn't soybeans or Boeing aircraft, it's rare earths. China accounts for roughly 69% of global rare earth mine production and 92% of processing. In one of the most strategically sensitive supply chains in the world, dependence remains real and alternatives remain slow to build. The U.S. pressed for access to yttrium in Paris, a single rare earth element used in jet engine turbines, not a comprehensive rare earth deal, not a restructuring of the supply chain, access to one element. That tells you everything about where the leverage actually sits in this relationship. The U.S. has the largest consumer market in the world. The dollar remains the global reserve currency. The U.S. military is the most powerful in history. But in the specific supply chains that the next phase of economic competition will be decided on, semiconductors, rare earths, battery materials, and advanced manufacturing, China has built structural advantages over 30 years that cannot be reversed in a summit. Analyst Gracelyn Bascarin said China has been building its processing edge for more than 30 years, while non-Chinese capacity remains comparatively small-scale. The summit in May will produce language about rare earth cooperation. It will not produce rare earth independence for the United States. Let's make this concrete. Between now and May 14th, markets will price in summit optimism. Technology stocks, most exposed to U.S.-China tensions, will be volatile around any news from either side. Watch NVIDIA specifically. NVIDIA's China revenue fell from 20% in fiscal 2024 to just 9% in fiscal 2026. That decline happened with or without summits. A framework agreement doesn't reverse it. At the summit, expect announcements about agricultural purchases, Boeing aircraft, and language about stable bilateral relations. The market will rally on the day. The rally will be partially reversed within 2 weeks as the gap between announcement and implementation becomes visible. After the summit, the structural competition continues. Export controls on semiconductors remain in place. Investment restrictions remain in place. The rewiring of global supply chains continues regardless of summit language. The modest expectations surrounding the Trump-Xi summit highlight a broader shift in U.S.-China relations from engagement towards strategic management of rivalry. The pattern from every U.S.-China diplomatic event since 2018 is the same. Short-term market reaction to diplomatic signals is larger than the long-term economic impact of actual policy changes. The market moves on the announcement. The economy moves on the implementation. The gap between those two timelines is where most retail investors lose money, buying the optimism and selling the disappointment. Watch the language carefully when May comes, not the headlines, the specific language. Framework means nothing was resolved. Agreement in principle means negotiators will meet again. Historic deal means something small happened and both sides need to sell it domestically. The U.S.-China trade relationship is the defining economic story of the next decade. May 14th is one chapter of many. The delay of the Trump-Xi summit is not a crisis. It is not a breakthrough. It is a reflection of how complicated this relationship has become, where a war in a third country can reshape the timeline of the world's most important bilateral meeting. What history tells us about trade conflicts of this scale is that they don't resolve in summits. They resolve, or they don't, over years of accumulated decisions, investments, and structural shifts. The summit in May will produce headlines. Some of those headlines will move markets. What it won't produce is a resolution to a competition that has been building for 20 years and will continue for at least 20 more. In the next video, we look at the last time America tried to win a trade war with its largest economic partner and what actually happened. See you then.